Ladies and gentlemen, it's a privilege to welcome you to this webinar. We are very fortunate to have an excellent panel of speakers here with us today for this session, which will focus on funding options for technology companies. Will Prendergast is a partner in venture firm Frontline. Stephen Smith is CEO of sports performance technology company Kitman Labs. Paul Swift is head of technology at Bank of Ireland. And Dan Harkin is a corporate transactional lawyer, a senior associate here at Mason, Hayes Curran. I'm really looking forward to hearing their perspectives, given the unusual landscape we find ourselves in, which in some respects has heightened the importance of technology, and therefore the relevance of technology businesses that are trying to scale and seek funding. My name is Robert Dickson. I'm a corporate partner here at Mason, Hayes Curran. I do a lot of transactional work in the technology sector. The technology sector generally, and working on funding rounds with technology businesses, is a major part of our business here at Mason, Hayes Curran, and something we're well known for and love doing. So to kick off the webinar, we're going to ask everyone attending the webinar to give some views on a few questions which are relevant to what we'll be talking about. And I really look forward to seeing the results of those. So if the first question could be published on the screen there, you'll see that it is, what is the form of fundraising for tech businesses you are most typically involved with? Straight equity investments, venture debt, alternative lending, or equity or debt hybrid. So if you can vote now, we'll give 20 seconds or so to see what the results of that are. Okay, so an interesting mix. So straight equity investments is the largest one, but not completely dominant. I'd say equity and debt hybrid was similar. 0% for alternative lending, which is low, and venture debt 12%, which is somewhat representative. So okay, that's really useful for us. Maybe if the next question could be put up now. So based on your personal experience, what is your sense of the market and expectations as we move towards Q4 in terms of fundraising for tech businesses? And obviously you have to pick one if you're going to vote, but if one of them fits what you think, but it's a period of great opportunity for tech businesses, or cautiously optimistic, or I expect the forthcoming period to be very challenging for tech companies to successfully raise funding. So again, if you can vote, we'll give a little bit of time. And again, it's a really good chance because we've quite a lot of people attending today to see what your perspective is on what's coming in the market. Okay, so a little bit of a mix. I'd say I felt that cautiously optimistic might win, and that's a fair answer. I think then for 45% was cautiously optimistic, and a challenging period to raise funding was 30%. But I think at least a quarter saying it's a period of great opportunity for tech businesses is an interesting result as well, in terms of showing there's certainly plenty of sentiment there. So you know, we've got 70% there saying they're optimistic to one degree or another. Okay, maybe the next question could be shared. What has your experience been of trying to close deals remotely in the past 6 months? And obviously, if there's anybody who hasn't tried to, then the question might be less relevant for them to answer. But this will be interesting to hear what people think. Either it's the new normal, not a bother, some challenges, but nothing insurmountable, or absolute nightmare. So looking forward to hear what people think of that. Okay, so again, probably a bit like our cautiously optimistic answer, but far more dominant. I'd say there are challenges with it, but generally people are coping was 85%. So a very clear result there. The new normal, not a bother. I think it was a bit of a bother for nearly everyone, at least a bit of a bother, and absolute nightmare. Some people have obviously had some painful experiences in terms of that 7%. So that's interesting to hear. Okay, and we have one last question before we get going with our discussion, if that could be shared there. So finally, what is the greatest challenge you typically face in fundraising transactions? And this is in the normal course, but also you could maybe say that the remote piece could come in here as well. But is it due diligence, so target company issues not resolved and documents not available? Is it negotiations becoming protracted on the terms of the deal itself? Is it third-party regulatory delays of one form or another? Or non-availability of key people involved with the deal? So very interested to get your take on that, because it's certainly one element of fundraising is actually execution and trying to get it from an agreed at high level position to actually having binding documents signed. Okay, so a little bit of a mix, but two quite dominant answers, I would say there. So certainly due diligence, target company issues not resolved and documents not available. Okay, and negotiations become protracted. It was high. Regulatory delays weren't really a feature here. And again, non-availability of key people, suggesting people are generally available, but still that was 12%, so high enough. Okay, I think that's been good to get the input from everyone on that. I think the first thing I'd like to do, I mean, as I said, we're absolutely delighted to have the panel here today that are coming to the table with very different and fresh angles on, on fundraising in the tech sector. They're coming at it, as I say, from different in terms of venture capital side and company that has raised funding side and lender and Anne as well, who sees things on the, from the legal side. So what I'd like to do, if I may, is just ask each of them so everybody understands precisely where they're coming from and what their role is in their organizations. Maybe I could ask you one by one to maybe just tell us who you are and your role in your organization so they understand that. Maybe Stephen, could I call on you first to do so?
Sure. Yeah, my name is Stephen Smith. I'm the CEO and founder of Kitman Labs. We're a sports analytics company who have offices in Dublin, Ireland, Wigan in the UK, and then California in the US, where I'm based right now.
Great. Thank you very much, Stephen. And Will, would you be able to introduce yourself next?
Yeah, hi, everybody. Will Prendergast. I'm a founder partner at Frontline Ventures. We're a venture capital firm that invests in business-to-business software companies only, both in the US and in Europe. And we're investing out of offices in Dublin, London, and the US, or probably more specifically out of people's bedrooms and spare rooms at the moment in those geographies. Absolutely.
And Paul, maybe you do so next.
Thanks, Rob, and thanks for inviting me. I'm Paul Swift, Head of Technology, Media and Telecoms at Bank of Ireland. I'm one of 8 sector heads, all hired into the bank from our various industry sectors. I'm a passionate advocate for the sector, and I suppose work with colleagues all over the country to assess companies in my sector who are actually seeking debt. Role very much focuses on translating the various business models and nuances, and I suppose how the companies fundamentally make money. This is very much about enabling, I suppose, our colleagues and the bank to understand the businesses and I suppose to support decision making around kind of companies, I suppose, their ability to repay their loans essentially.
Okay, that's great. Thank you very much, Paul, as well. And Anne, maybe you'd introduce yourself as well.
Hello, thanks, Rob. My name is Anne Harkin. I'm a corporate senior associate with Mason, Hayes Curran, and I work closely with a number of our clients who are companies in the tech sector looking to raise funding, and that's at various stages of their life cycle, so going from earlier rounds up to later rounds.
Great. Well, that's it. I think it's, as I say, it's really, I'm really looking forward to hearing everyone's perspectives on what we're going to discuss. And Paul, could I start with you? As you say, as TMT sector lead in Bank of Ireland, can you give your overall perspective of the tech sector in Ireland in the context of COVID right now?
It's varied, Rob, I suppose, because technology, media, telecoms, I suppose, in terms of there's various subsectors within each of those. And I suppose what we've really seen is that some, I suppose, have been impacted. It's been a boon for some, right? I mean, because obviously what we're doing in terms of working from home, there's been various technologies, companies providing those. We've a number of customers who are doing product portfolio management type of software. They've seen a boon themselves. But conversely, we've also seen customers are in the travel, aviation, and hospitality space in terms of delivering solutions into those, and they have been disproportionately impacted, in a negative way. Hospitality is beginning to slightly recover, but it's going to be pretty much, I suppose, a longer term kind of play in terms of getting those ones back up and running, or at least for them to see kind of, growth again, I would think. But also we've actually seen over the last kind of 6 months, we've seen a number of customers, and certainly we've seen generalists as a lot of customers innovating really. Number of companies have been trying to, because of the way the health system kind of needed help, I suppose, really. We've had a number of customers who've repurposed technology and things like, in terms of patient monitoring or remote monitoring, repurposing the tech to enable, I suppose, capture symptoms of COVID-19. And those companies have actually, that company particularly, have actually seen growth in, obviously, because the way the HSE and NHS and even further afield now have, I suppose, flattened their procurement models, have enabled them to kind of get going on that. And generally, in terms of the whole telehealth space, we've seen kind of, I suppose, a big growth in that, because there's a number, obviously, you look at GPs now, we're in a war now where we've remote consultation as well. So it's been, as again, there is some recovery, and we're seeing some companies, as I said, we're doing really well as a consequence. But and then the other side of that, then you've had more traditional businesses as well who are about to embark on the whole digital transformation journey, and they themselves then are becoming customers of more of our tech companies as well. So I suppose it's there's a lot of positives, but as I say, it's those who are more negatively impacted. I think it's going to be a difficult time for them, and we may see casualties, I suppose, as a consequence.
Yeah, absolutely. I think you're right, Paul, to point to the different subsectors within tech. When we talk about tech, there's so much going on there, and even within that, just as across the wider sectors in the economy, unfortunately, it's a very, very difficult time for some sectors. But even within tech, there's kind of shades of grey there as well, I guess.
Absolutely, because you'll see it. I mean, even telco, you'll have some companies who are developing some solutions in that because of, say, around projects. And projects maybe would have been stalled because of, companies would be kind of, I suppose, looking after a cash flow positions and would have probably held back in running out. So there's been some of those companies, would have been some of those companies actually developing or delivering sorry, my apologies, I did put on dinner store, but I still got a call through. But yeah, there's others in terms of actually, telecoms as well have issues. So again, it really comes down to even subsector by subsector, and even within those, again, it breaks down further.
Absolutely. Will, can I ask you about the last 6 months and kind of venture capital firms and so forth? Obviously, there was a sense initially that some venture capital firms would have understandably been quite focused within that period on their own existing portfolio. And anyway, I don't want to put words in your mouth in terms of how that has progressed over the 6 months to a kind of new normal and so forth. And we saw the results of that question about cautious optimism and so forth. But talk us through how you would see the kind of temperature having evolved over the 6 months in terms of venture capital and willingness to invest?
Yeah, so I guess we're in a very different place to where we were in March. And I think about that activity question as kind of both capacity and then kind of caution. So I think in March, April, May, there was a capacity question, because as COVID hit, I think all of the senior individuals within the venture firms focused internally on sorting out the issues and right-sizing the cost bases of their portfolio companies. And then it required a lot more reporting to the investors in those funds. So I think all senior investment professionals were kind of off the pitch for those 3 months. So that if you look at data for that period, I think it's probably not representative of anything. But after that period, I think you can start looking at the caution side. And I think for venture firms, it's a fairly simple business model. Cash comes in from one side and then goes out to the startups. On the cash in dimension, there's still a lot of the capital that comes from governmental organizations into these funds. So for example, in some of our funds, we have Enterprise Ireland as an investor, the NTMA, we also have AIB Bank, and the European Investment Fund. So those organizations have actually kind of moved in to support the venture industry that can in turn support startups. So I think the capital hasn't dried up on that side. If anything, there's a lot of noise about, extra support. And then I think the other thing that VCs look at is the public markets, because they're trying to figure out, can our companies fundraise at the next step, and ultimately can they, go public or get acquired? And the public markets, it's a longer story trying to make sense of that, but the Dow Jones is probably a little bit above where it was in January, but the NASDAQ, so the tech index, is up 30% on where it was in January. And the high growth tech companies in the kind of subset of that is up about 50%. So if you've got, good cash coming into the funds and the public markets are up, it's kind of quite difficult to be cautious. So I think the funds themselves are, we haven't seen caution. I think it's very different though as you go into family offices, angel investors, and other kind of non-institutional groups. I think in those groups there's a big uptake in caution, and I think those parties will be much less active in the next kind of 6 to 12 months.
That's really useful, Will. I mean, it's obviously, when we look at the Irish market and the IVCA publications of data, obviously it's a more kind of, we're looking at our market, and you're obviously commenting on, quite rightly, on the wider situation, which we're all interested in. I think certainly the Q2 results from the IVCA, I mean, broke records in terms of value of investments, but a lot of it was kind of large sort of follow-on funding with Series B, Series C, some of which we would have been involved with here. But I think a big reduction in kind of first-time investments for certain companies. So I think it's kind of, yeah, it's a more narrow thing in terms of looking at the Irish market, but it's really useful to hear those perspectives, and some very good points you make there about the value of the NASDAQ and so on. Okay, but can I move on, Stephen, in terms of yourself? I mean, the products you make in Kitman are obviously fascinating, and we've seen ourselves in the past number of months, I mean, have you seen, but we certainly, in terms of following media and so forth, we've seen a kind of an impact on the mindset seemingly of sports organizations. You look at look at rugby teams kind of studying different ways of performing. There was a bit more time, I suppose, that some of them would have had when they weren't allowed to compete in competitions and things like that. So what have you seen in terms of their mindsets, in terms of sports organizations and their willingness to engage with you, or has it been interesting in that, from that point of view, for your business?
Yeah, I think, listen, it's been no different than any other industry, in that it was a huge economic shift in the landscape of sport. And sport traditionally relies heavily on bums on seats and getting people into the stadiums, and the TV rights and getting games televised. And I think that shift from being able to play games and leagues getting turned off caused a lot of uncertainty within the sports market, because it meant that people were very concerned about funding. And I think that was cause for pause for a lot of teams, and they spent a lot of time looking inwards and understanding where are they spending their money and what can they continue to afford, and how do they build their businesses internally. And I think that's allowed teams to be a lot more strategic, and it's allowed for a lot more time for innovation. And I think from our perspective, it's what we're hearing is that, well, there's probably going to be less money available, let's say, within the global transfer market. And that means that there's more reliance on the current squad that they have, on their academy structures for internal development, and teams have to find internal efficiencies. And I think in terms of how we responded to that, I mean, we felt that the only way to survive through that is to be, is to lean into that, and to be a real asset and a real strategic partner to our customers, and to help them to find those efficiencies, to help them to learn how to develop talent better, to help them to learn how to optimize the talent that they have better, and to find efficiencies in that. And we took a very, I think, progressive stance at the beginning to reach out to all of our customer base, and that's big. We've over 500 teams globally using our tools, and that's a big undertaking. And we took a big step forward to say, okay, we understand things are different. You're going to have to use our tools in different ways. And we helped them to think about that. We helped them to learn about other things that they could do with our tools and other ways that they could react to the landscape that's out there. And I think, to follow on to what, Will and Paul were seeing, for us, that worked immensely because our customer base has responded really well. And in addition to that, we probably did what lots of companies haven't done, and we raised funding in the middle of all of this. So, we closed $6 million in follow-on funding from a new investor, not from follow-on funding from previous investors. And I think, from what we heard in our discussions with new investors about where we wanted to go and the response and attitude that we had in terms of leaning into the issues, and I suppose the impact that we were seeing that have in the marketplace, there was huge excitement, and there was a lot of excitement from investors about, there are going to be winners in times like this, and there's going to be losers. And I think, people still want to take bets and still want to push on the organizations that they see are going to champion that and are going to go and push forward and make those big stepwise kind of progressions and improvements. And luckily we found ourselves on the right side of that.
Yeah. And congratulations on closing that round. It's certainly, it's certainly an achievement, but demonstrates the ability to do that, certainly, certainly in this market. And that brings me on in terms of Anne. I mean, as a corporate transactional lawyer, like myself, is it your experience that deals involving tech companies have been happening over the last 6 months?
Yes, Rob, like as you alluded to a little earlier, I think the data that's out there in the market shows that the money raised by tech companies in the first half of the year is ahead of 2019 and broadly on par with 2018. But as you also alluded to, there is commentary there that perhaps those figures are slightly distorted given that there were one or two or three very big Series B and C raises. But leaving that aside, I suppose we can only speak from a Mason, Hayes Curran perspective and what we have seen. And from that perspective, we've seen a steady flow of deals come in all through the pandemic from the start of the year. And that's across, different rounds. We've done seed series, Series A, right up to Series C. Now, as Stephen and Paul alluded to, the pandemic has provided a tailwind for some industry or some businesses in this sector. So perhaps we were just fortunate enough that they were our clients. But speaking, I suppose, purely from a Mason, Hayes Curran perspective, we have seen a steady flow of deals in this sector during the pandemic, and it's on par, if not ahead of other years.
Great. Well, thanks for that, Anne. I want to move on, everyone, to kind of types of funding, and that's one thing in terms of funding innovation that we wanted to speak to everyone about. What's available for tech companies? It's not always the same, and obviously we had our poll question there, which indicated a lot of people are seeing hybrid, a lot of people are seeing straight equity, and there's a little bit of venture debt there. Will, maybe you talk us through the type of funding models venture firms tend to invest through. I've talked about equity, I've talked about debt and hybrid, and what's your sense of market trends around that?
Yeah, I think maybe ironically for an industry that invests in innovation, the venture model itself hasn't changed a lot over the last 50 years. So I think the equity venture funds kind of business, there's really not much to look at there. The business models have stayed the same. At one stage a couple of years ago, AngelList, offered the promise of a lot of angel investors collectively investing in companies. It probably didn't take off at the level that I was expecting in Europe, but that's the kind of closest it's been to innovation. So I think the venture model structures have stayed largely the same. On the debt side, and I talk about venture debt here, which is probably closer to VC equity style than it would be to a bank debt. So I think venture debt has become definitely a feature of the market. I would say 5 years ago, none of our companies had any venture debt, and I think now at least half of the companies that get over 30, 40, 50 employees would have venture debt in there alongside our equity. There aren't, there's probably a few hundred venture firms in Europe, but it feels like there's maybe 5 or 10 venture debt firms. So it's a small group of firms But once you get above a certain size, that is a product that people can use, and it is accessible. And then, like, the only other models, the interesting debt models that I've seen, there's one company, I'm not if there's any e-commerce companies on this call. We invested in a company in Canada called Clearbank, BANC, and they have an interesting funding model where they will, for companies that generate new sales from ad spend, they will fund your ad spend only, and then they'll reclaim that loan out of the revenue that you generate from that sale. So it's a very specific type of product focused on e-commerce. They call it the VC killer, as in it replaces what the VCs would do, but it's a very tailored product. So in fact, it's great for those e-commerce companies. So that's really what I've seen. I think we'll see the government agencies, both in Ireland, UK, and Europe, step in a bit more on the debt side. We've seen that with the European Investment Bank. We've seen it with some of our companies, and you've also seen it in the press where they've stepped in. And I think there's other products that are coming out from the ISIF, NTMA, and I suspect Enterprise Ireland is beefing up their programs as well. So I think you'll see different types of products there.
Yeah, that's a really good summary, Will, and thanks for sharing your experience on that. I think part of what you mentioned at the end there brings me on to something I wanted to ask Paul about, which is kind of other routes to capital, kind of on the debt side, kind of debt-based government schemes arising from the pandemic, really. And obviously these are very relevant to Bank of Ireland. So would you mind giving us your views on those, Paul, and from your perspective in terms of what you're seeing and what they are?
Okay, well, there are a range of schemes at the moment, Rob. So I suppose just to give you a breadth of that, you've got the COVID-19 working capital scheme. You've got the credit guarantee scheme, which is actually just being launched at the moment. And then you've got the future growth loan scheme. And if you look at the three, I suppose, schemes, they're essentially, it's almost, the working capital one will be aimed at kind of short term. The credit guarantee scheme being launched will be looked at medium term, and then the future growth loan will be longer term. So you're looking at terms for the working capital scheme from a year to 3 years. For the credit guarantee scheme, you're looking at terms from 3 months to 5.5 years. And then for the future growth loan scheme, then it's the term of 7 to 10 years. The purpose typically for, we say, the credit guarantee scheme and the working capital will be very much around working capital measures, etc. Funding innovation, you will be able to fund under the working capital scheme. And then we say mitigating any issues that you might have around kind of for business changes as a consequence of COVID-19. Whereas the COVID-19 credit guarantee scheme is very much purposed towards investing very much in your business, and then again obviously around working capital. And I suppose the difference with the future growth loan scheme, then it's and I'll come to it in a minute, but it's very much around innovation and enable you to fund R&D. I suppose just in terms of the amounts, really you're looking at the working capital scheme starts at 25,000 and goes up to $1.5 million. The credit guarantee scheme goes up to I think that actually goes up to from 10,000 to $1 million. And then the future growth loan scheme goes from 25,000 to 3 million. So I suppose there's the rates. I won't get into the rates now. If anybody who's on, obviously they can see this on the website, on the Bank of Ireland website, and they'll be able to kind of familiarize themselves with it. Just in relation, I suppose, to the expiry timelines, where the working capital scheme is due to expire in March 2021, or unless it's fully subscribed before then. But the credit guarantee scheme, again, being launched at the moment, that's due to expire on the 31st of December this year. So really facilities would have to be entered into on or before the 31st in order to be able to avail of that scheme. And then the future growth loan scheme, that was set up in 2019 as a 3-year scheme. And basically it's a similar, that will run the course, or if it's kind of fully subscribed in the meantime, then that will come to an end. Just in relation to eligibility, I think it's important, the standard underwriting and kind of our credit criteria would apply to all of these loans. But again, it's very much around both the working capital and the credit guarantee scheme. It's about really those who are applying for it furnishing to be able to demonstrate that they've been impacted, be it their turnover, be it their profitability, or even the projected turnover that's been impacted by more than 15% in terms of, or down 15%. And likewise, in terms of the future growth loan scheme, companies will have to be, because there is a state aid guideline piece in this, so they'll have to furnish SBCI with the various SBCI will make essentially assessment on the businesses, and after which, once they once they meet the criteria, then they'll be furnished with a code, and from there they can proceed with the application. I suppose just from a tech point of view, Will, I would see from my sector, certainly Future Growth Loan Scheme, I suppose it really is, it's kind of more appropriate, I think, for tech businesses. I think it allows profitable businesses to invest in R&D and in innovation, and I suppose spread the costs of the repayments over a longer term. So I think I'm certainly seeing it. I've had a number of companies who are talking. I work in a number of cases as it is, and I would say that probably is more appropriate. Maybe potentially being this a tech webinar, dare I say, or tech centric one for innovation and funding, I would say it's probably maybe more appropriate. But again, intending or applicants would certainly have to satisfy themselves and take a look at the various criteria on the website, and then obviously in terms of making contact through the relationship managers or through the bank.
Yeah, and that's really useful, Paul. I think in particular both the summary, but also the piece that, where in terms of tech businesses, what's most appropriate for them. So thank you for that. Stephen, I'd like to just hear a little bit from you in terms of, obviously you're now a business of scale that has successfully raised funding, but I mean, in terms of equity funding, I mean, is private equity and venture capital, obviously those are kind of options, but what's your view in terms of different options that are available for a business looking to raise equity funding like that?
Yeah, I think, listen, to piggyback off what both Will and Paul have mentioned, there aren't a huge amount of options that are out there, right? But I think primarily we made use of straight up venture capital and equity model in our earlier days. We're seeing a lot more interest from the PE growth type side of things right now. And I think we've also been offered on numerous different occasions venture debt, and that's something that we know is kind of available. I think lots of different people that I've spoken to have different feelings on venture debt and its role and how that plays out. I think other things that nobody has talked about yet is grants. Like, there's a huge number of grants, especially to European companies. There's a large number of grants that are available for different types of research and innovation components. And I think that's a really, really powerful model for early stage companies to partner along with the straight up equity pieces that they're working on. And that can be really helpful for you to kind of supplement what you're doing and allow you to add more muscle, to really allow you to kind of grow quickly at earlier stages. So that's something that we've always tried to capitalize on. But I think for the most part, companies generally use a blended model of financing that really suits their stage, their kind of current traction, their growth needs, and also their risk appetite, because all of these different instruments come at a different price to your business, and it depends on where you're trying to get to, and how much risk you want to take in that, and also how much dilution you want to suffer from, and where you really believe the end stage for your company is going to get to. So I think you do have to be thoughtful about it as an operator, because you're putting everything that you have into it. So you need to be careful with the instruments that you use, and also the people that you get into business with regards to that.
Yeah, I think that's really helpful, Stephen, really useful. I think your point about the grants is a good one, I think, for everyone, particularly businesses, but also we should all be aware of what's available in that respect. But certainly for a business, it's possibly not something that everyone would think about. So very, very well made point on that, I would say.
And Robert, just to mention, guys, I think it is a good point in the grants to mention two of the programs we see most actively. There's the Horizon 2020, which a number of our companies have availed of. And then a newer program in Ireland, Horizon 2020 is European-wide, the Disruptive Technology Innovation Fund, I think it's called. So we've seen a number of companies get that. So those are two on top of the ones that Enterprise Ireland would have.
That's great, and thanks for that as well, Will. I'm sure there's attendees who will, who that'll be very, very much relevant to, and good to point those things out. We're going to continue on. Just to say to those who are watching the webinar, there is an opportunity if you want to pose questions via the Q&A, I believe. Then we will look to get to some questions in a little while. Conscious of finishing up at 2:15, so we'll continue, but do pose questions and we'll look to deal with them. Anne, you've worked with, as you've kind of mentioned earlier, you've worked with some really, really major Irish success stories that have, that have started up and rounds of funding to the point they're just hugely valuable tech businesses. In terms of structure of those deals and as the funding is raised, does that change much through those rounds? And do you see those companies kind of raising money between the rounds in any way?
Yeah, Rob, I suppose what we would say is in terms of the structure of the deal, what we find a preference for with clients is to use the same sort of contract basis that they've started on their Series A on and replicate that for the later rounds and just update it with the particular requirements of the investors coming in on that round, usually involving creating a new class of share to deal with the rights that they've looked for. That would be what we see as preference from clients' point of view, because it saves in terms of costs and time. It's just more efficient to use the same document. And that is true. There are a couple of downsides from doing that, because obviously every contract is negotiated and there's things that are conceded that you might not want to have in a first draft going at a later round. But it's very difficult when you have to run your red line against what you gave the investors in the last round, if you take out some investor-friendly provisions that you conceded prior and try not to give them on this round. So I'd say that would be the downside. And it's also important to note that, like, for a Series A or an earlier round, there's certain warranties that you might be comfortable giving when the company's small and it's maybe only operating out of one jurisdiction, and the founders are very involved in the day-to-day running. But as the company grows and maybe you're based across a couple of jurisdictions and the founders don't have that level of hand-on day-to-day running over every aspect, and they're being asked to stand over warranties that, as I say, more appropriate when you're a smaller company. In terms you asked about in between rounds, we have seen an increasing prevalence of using bridging finance. I suppose with fast growth scaling companies, they're never too far away from running out of money, and this usually comes knocking around the time that they're going out to look for other investment, and they realize, look, this process takes a while, and it takes them a bit of time to lock in certain investors or negotiate a term sheet, and the company's quickly running out of money. We find a bridge financing, usually in the form of some sort of a convertible loan note, is becoming a frequent feature of a pre-transaction to the actual transaction, usually with that convertible loan note converting to shares in the next round at some form of a discount. And interestingly, what we find in the majority of the cases where we've seen this bridging finance structure used prior to a deal, that it's either the existing investors or in fact the new investor that provides the bridging finance, and they're happy to do so without taking any form of security, so no debentures or anything over the assets of the company, which from the point of view of an existing investor, you can understand, because they already have their shares in the company, they already have their their foot in the game. But for a new investor, to put money in unsecured when they perhaps haven't finished their due diligence process, I find interesting. But that's definitely a feature that has been a feature of a lot of deals that we've seen this year.
Yeah, that's a really useful trend for people to be aware of. It's probably just things moving very quickly with some of these businesses.
That's it, yeah.
Good to be aware of it. Okay, I want to move on to a little bit about the decision to fund, and what happens next. So, Stephen, obviously you're CEO of a hugely successful business that's taken funding at various stages and grown extremely successfully. When you get to that point where you decide, and generally it's not that late in the day, so to speak, but you make that decision that you want to take funding, what is the next step in getting the process moving for a successful fundraising?
It's a good question, right? And it's one that I hear a lot from earlier stage businesses and new CEOs, right? And I'll probably answer this very differently than I would have had 4 or 5 years ago. But I think people have this misconception that fundraising is something that happens at discrete time points, when the reality is that fundraising is always happening. And I think in my role as a CEO of a fast growth company, it's one of my core responsibilities to ensure that we have the capital needs to support our growth and allow us to change the world through our products. So my belief is that for products that want to change the world, provide huge stepwise progressions and capabilities that take significant investment, and therefore your role from a financing perspective becomes evergreen. I think raising money is all about networking. It's all about building relationships. It's about accurately forecasting the future of the market and our specific role within that. And I think for us to be successful, I have to tell the story to the right people who share my passion for that, and have I suppose have the ability to be able to help and play their role effectively also.
Yeah, well, that's really useful. Thanks very much, Stephen. Paul, in terms of then the decision to fund and the lending activity that Bank of Ireland does and is willing to do within the tech sector, what do you take into account in making a decision as to whether to lend to tech businesses?
Just to say, starting out, Rob, I'm in a lucky position, I suppose, that we have a team in Dublin, a dedicated lending team, one below 500k and another relationship managers and one that works above it. And I suppose we work very much collectively. So I suppose we've built out a real kind of solid understanding in terms of the bank's position, in terms of what is a bankable deal. And I suppose in simple terms, really, if you look at it, it's very much people, product, and profitability, really. And it's commonplace. You'll hear this a lot of times from others saying you're really looking at the team, you're looking at the quality of the team, the experience of the team. Have they done it before? Excuse me, or in some cases if they're learning on the job. In terms of, pretty much it's about the kind of track record to get a good understanding of what they've done. And as well as that, I think a big factor as well is if there's a good, some advisors or NEDs involved as well. I think it's always a good statement as well of where kind of a statement intent of companies that we're talking to in terms of where they're aiming to go. The other one is very much around the product. And I suppose when you look at what Stephen's doing in terms of, it's really that uniqueness, it's building that, that real defensibility. I says, because we're always looking through a lens of, are they going to be over the duration of the term of the loan? Is the business realistically going to be there, or is it going to be around in terms of what our exposure is? So it's really getting a good understanding of what the product is, kind of, as I said, and it's and really, I suppose, even COVID has taught us lessons around. You're really looking out for even, and I'm just for simplicity, I'm looking at this through the lens at the moment of kind of a software company. But what you're really looking for now is even kind of software that can be applied to more than one vertical, because I think COVID has very much demonstrated that those will be very much all in on one sector. It's a situation that they've actually been kind of, I wouldn't say burned by, but just found that where they could be a leading player in one field, but then something happens. Just using the travel tech example, that they're found to be, through no fault of their own, they're actually found that it's very difficult to pivot. And I suppose profitability very much for us as well. I mean, I'm not in Wales kind of a parish, so to speak. So it's very much for us, it's very much about, being able to demonstrate the ability to repay. And it's very much based on kind of being able to, from a point of historical and kind of current performance, really. So it's we get a good understanding. And again, we would take into account the like of recurring revenue, contracts, stickiness, in terms of and where they're growing in terms of their margins, and et cetera, et cetera. So being able to, obviously, again, is very much profitability. Loss-making companies for us, unfortunately, it would be typically outside our, depending on where they're at, would be outside of appetite or our risk appetite. But I suppose the last thing just to say, I think we as a team work very closely with, when we have applications, as much as we possibly can, we try to kind of signpost or connect, add value in some way. If it's not a deal that we're not comfortable with, or it's maybe too early, which sometimes they are, we try as much as we possibly can to add value in terms of introducing to investors, or at least we have, obviously the bank has invested through to a VC community as well. So that's where we'd actually try and find an opportunity to help companies. So it's I suppose it's adding value, even if you can't, I suppose, if it's not a positive, I suppose, approval, shall I say.
Yeah, that's very useful, Paul. I'd like to hear from actually both Will and Stephen, if I may, and get their perspective. Now, we asked the poll question about the most challenging aspect, or something that delays deals or makes it difficult, but everyone will have their own experience of that. Will, for you, what's the most challenging aspect of the deal and fundraising?
Yeah, I guess I've been on both sides of this one, having raised our own funds and then, seen a lot of people raise. And, if I could encourage people on this session to focus on one thing, it's making sure that you're in the right room to start with. I think many entrepreneurs see a source of funding and just want to get in the room and kind of sell the vision. But I think if they spent more time on qualifying whether that was the right room, I think they ultimately would be more successful. So, you know, as I said, I say that having made the mistake myself, but the temptation is always to get in and pitch. But I think it's like a sales process. If, you know, the qualification step, if you invest in that, you will end up in a smaller number of rooms where, you know, you're pitching to the right person. And I hate to see people invest time when they're, you know, that they're not in front of the right party that's going to fund it anyway. So that for me is probably 50% of the battle, which I think even for entrepreneurs, they probably think that it's, you know, 5 or 10%.
Yeah, that's actually really good advice for people, Will, I think, and thanks for that. Stephen, from your perspective, what's the most challenging aspect of fundraising?
I think, listen, it's like every aspect of business. It's dealing with human beings. You know, I think that's the most challenging aspect of everything, right? We're all different. We all see the world in different ways, through different eyes, with, you know, a different context and different perspectives. And I think helping to overcome that and align people to see, you know, the future in the same way that we do, that's the real key. And I think, again, it's not something I did particularly well in my earlier days as a CEO, but I've learned a lot more about, you know, how to help people understand what I understand and see the world the way I see the world, and that has really helped. Because I think we all have our own internal ladders of inferences, and I think if you don't convey that, and if you don't help people to, you know, to come on that journey with you, it can be very challenging.
Thanks for that, Stephen. That's really useful too. Listen, we have run out of time. I want to thank, first of all, everybody who attended and asked questions. That was great. And I suppose most of all, I want to thank each of our panelists, Stephen, Will, Paul, Anne, each of you. It's been really useful to get your perspectives. I wish I could ask you questions for hours, because I think you've a huge amount to contribute to people in terms of advice and very relevant experience here. And it's obviously a fascinating time in terms of what, for the tech sector, that, you know, there's such you know, there are businesses that can pivot so well in what's a very challenging time generally, I suppose. But I think you've drawn out those points very well, and, you know, it's been great to hear what you've had to say. So thank you very much to each of you, and to everyone who attended.
Thanks, Rob.